Hi, good evening, everybody, and you're welcome to the first Zoom meeting for Dairy Women Ireland for 2026. I hope you can all hear me okay.
Okay.
We have Alva on tech looking after things in the background, so thanks to Alva. And this evening we are delighted to have our very own Mary Kinston presenting on financial strategies and resilience for a secure future, and that's, I suppose, looking ahead to 2026. And we also then have Donal Whelton with us, who is Head of Agri for AIB. Delighted to have Donal and his experience and knowledge to present to us also afterwards. So we might just give maybe another minute for a few more people to join us. And then I'll introduce Mary. I suppose let Mary just give a little bit about her background and I suppose her experience in financials and her groups and her consultancy. And then she will present. And if there's any questions as we go throughout, please, you can either raise your hand if you want or just put it into the chat function, and then we can bring up those questions as we go along. And there'll be an opportunity as well at the end of the meeting if anybody would wish to add in any further questions. So welcome, as I said, and Happy New Year to everybody. So Mary, I don't know if you're happy to unmute if you're on the call there. And
yes, can you hear me, Deirdre?
yeah, absolutely, Mary.
Lovely. Okay, yes. So, welcome everybody. Yeah, so Mary Kinston, we're going to talk about strategies and resilience going forwards. Obviously, we've had generally a great year in 2025, but 2026 isn't looking so positive. So it's basically looking forward to how we actually cope with that. So yeah, just to introduce myself, as many of you already know, I live in County Kerry with my husband. Yeah, I'm dairy farming with him. And sort of over 3 farms. But I also look after discussion groups, 10 most of the time. And actually, I've just, we're up to 12 on financials this year. So at this time of year, I go into some sort of mad session of doing everyone's account. So I will process over 100 accounts in this month. And so while today we haven't got the 2025 data because we're just starting that process, I have a bit of an inkling to where things have gone, and we can refer to that. So look, yeah, what we're going to cover is basically the 2024 results, and I realize you might think, well, what relevance has that got towards 2026? But we have gone through a period of volatility, and it's that will provide the strategy to how to approach it. And then we will then obviously conclude. And here's a little bit there also in terms of covering working capital, and I'm sure the word slush fund or war chest will come up this year, probably after it, to the need to having one anyway. So we will just start with the 2024 data so that you can sort of see what I deal with in a year. So in terms of trend basis, so in 2024 I had 101 accounts, and the average profit in that data set was 18.33 per hectare. Now the key thing to get from this graph, that's a decent profit, and I will show you that, and we knew it was. Most people were very comfortable at that profit generally, but the key thing to get from this graph is that it is a bell-shaped curve, and at the top 10% achieving actually a profit of over 3,000 per hectare, and the bottom are actually achieving only a profit of just shy of €1,000 per hectare. So in terms of where that's gone in terms of 2025, it's more profitable actually in 2025, probably by an addition of about €400 to €500. So I expect the average profit to exceed €2,000 per hectare. So again, very, very comfortable. But it's the reality of where we came from prior to 2024 that we will refer to. So another key trend that we got in this period of time was the cost of production, including rent, which we don't compare between farms. When you're doing the profit monitor, it's always excluded. I always exclude it because some people have to rent the whole of the farm and some people have no rent at all. But it is a cost that has to be paid out. So the average cost of production, including land rent, is 41 cents, where the bottom 10% are actually doing it for 46 cents. So you can see into sort of the environment we're coming into now that that's going to be quite pressured, whereas the top 10% actually managed to achieve a cost of production of 35 cents, which gives them a huge amount more option in low milk price years. That the majority of herds are working in the space, for me, the lads I work with, between 150 to 300 cows. But I do have quite a variance there, either side of that. And the other thing I can also allude to from this average data set, I do work with farmers in heavy soils in high rainfall areas. And whilst the average achieve a profit of 18.33 per hectare, those heavy farms in high rainfall areas, because obviously the start of 2024 was quite a challenge with wet spring, what have you, they actually had only an average profit of €1,400 per hectare. So they're actually taking a hit of €400 per hectare. And I think probably the interesting thing to note with that, if we looked at it in 2023, when everybody across the country had a wet spring and a wet back end, that reduced to €200 of a difference for a heavy farm. But you need to know with what you're working with as well, make sure that, you know, when you compare yourself, that you're comparing apples with apples. So look, if we...
Mary, are you okay to go through that last point again there just briefly? I think we just kind of broke up.
Yeah, so I was just trying to
just
point
in
out,
relation to the wet farm from 2023.
So
sorry, there was a breakup. Yeah.
Oh, okay, sorry. So yeah, basically a heavy farm in a high rainfall area generally has a compromise on profitability because it generally can't be as productive as a drier farm. And it usually has a compromise on profit of about €400 to €500 per hectare. And the only time that didn't happen was actually in 2023, when all farms were hit with a wet spring and a wet back end. And that actually reduced to around €200 per hectare of a difference. The heavy farm is still compromised because it doesn't have as good soil structure to keep cows out, but it wasn't as big. A wet spring will compromise every farm in some form or fashion. Okay, does that make sense, Deirdre?
Yeah, no, that's fine. Yeah, absolutely great. Yeah.
Lovely.
So they're doing a good job of, you know, maximizing their profitability year on year, like, as you know, if you compare them to the wet year.
Yeah, absolutely.
You know.
So yeah, I suppose the other point is to make sure that, you know, when you do financial comparisons with other farmers, that your best relation is to somebody who's got a similar farm type to yourself. So like for me, you know, I soon realized it was living in Kerry that, you know, comparing myself to Moorpark was a little bit of pressure and it was unnecessary. So, you know, it's to try and compare apples with apples, essentially.
Yeah.
Okay, so if we look at how things have changed over time, this graph outlines the total income coming into the farm, which refers to gross farm income, and they're the solid lines. Now, there's a difference between the purple and the blue. It's basically that the top 10% in each reality is shown in purple and the median is in blue. Okay, so that's what the colors are referring to. And then the profit, which is referred to as COP, comparable operating profit. Again, the purple is the top 10% and the dashed blue is the median. So this is how things are trending over time. And while we talked about volatility in the past, prior to 2020, that volatility really doesn't seem particularly big. We've come into a different phase. So just 2022 was a lovely, unexpected dream year that I'd never thought I would see. But then we hit 2023. And I suppose some key lessons from that were that basically the income in 2023 dropped by 30% purely because the milk price dropped by 30%. But then it was coupled by a reduced output because getting good productivity out of cows was challenging because it was a bad year as well. So its worst case scenario is to put a low milk price with a bad year, and fingers crossed for 2026 we don't repeat that, but there is no guarantees. So in 2023 we were coupled with an 8% reduction in per cow production, and that then multiplied into a 65% reduction in profit. It was quite huge. And even though people try to reduce the cost of production, only reduced by 1%. So that is ultimately the biggest challenge when you're faced with a low milk price, is to try and get your cost of production down. A lot of things start to get very sort of set in stone, but that's the one thing you do have control over. So at this stage in the game, we're very much knowing that the milk price is quite low, and it's going to be low at least for the first half of the season. That is certainly going to be a necessary area of focus. So in comparison, then when we came into 2024, we didn't feel like it was going to be any good, but we had actually an increase in milk price of 13%, which again correlated to a 13% in income, but the actual milk income increased 18% produced milk, and resultantly, you know, it 50% increase in the profit occurred, and it became another line in this graph is the €1,000 per hectare, and it illustrates that prior to 2020, the average profit on farm €1,000 per hectare. It varied slightly from that, but not hugely. But whereas in 2023, the average profit was slightly above €1,000 per hectare, but you could see how uncomfortable people were in that year. Now, that was the average, obviously, again, referring to that bell-shaped curve, why the average is 1,000, there was some thousand. There's always that range, but you could see across the board how uncomfortable people had become when they were faced with 2023 hitting the average profit of €1,000 per hectare. And that's the other thing to realize, that we've had inflation, one in costs, but we've also had inflation in our demand for profit out of the system to cover our own drawings for debt servicing, and obviously the tax has to be covered after that, especially with volatility between years. You're covering the tax basically the year after, and like this year we've had a good year and we're going to be, so that is a bit of a challenge. So,
and Mary, where would you see that as a comfortable, you know, like if 1,000 a hectare is the average, what do you see at the moment as being where people might be a bit more comfortable?
I think we're probably always at this stage you'd want to see profitability probably above €1,500 per hectare for people to feel like they have a degree of comfort in the system that they're operating, and also the general scale that's out there. Yeah, you generally want €1,500 per hectare, but obviously, again, like I'm working with the bell-shaped curve. There's plenty of farmers that eke out a decent living on those more marginal farms, but they must make their, you know, cloth measure essentially. Yeah. So as I say, around that 1,500 can be fairly comfortable. It's just you can see the pressure once that gets squeezed.
Yeah.
Obviously, the other side of the coin is as well, the other thing that's not covered, especially.
I think you've just broken up there, Mary, a bit. If you just hold off for a second. Yeah.
Is that the comparable thing? Better now? I don't see any issues.
Yeah, no, we've lost you there, Mary, on that point again. Sorry, I don't know. It must be a connection. Yeah.
Am I okay? So
yeah, just the last point, yeah, and I'd say we can move on then. Yeah.
Yeah, so just to remember, when you're looking at profit figures by myself, or you're looking at profit figures by Chagas, there actually is no land lease in those figures, and obviously that has to be paid too. It is a cash cost to the business. It's not a comparable one, but it is a cash cost, and obviously they have become quite inflated as well. So that's also having a bearing on the market too. So these are the profit monitor results. They're comparable to mine, but they illustrate the same point. So just to be with those as well, just to show the relevance. This on a cent per litre basis, and it's the total cost of production, but it's a comparable cost. So again, you can see that that was working at around 38 cent per litre. I think the key thing to take from that is that that cost of production has now exceeded pretty much all of the milk prices that we have received prior to 2020. So that's the scary reality. We've inflated into a situation. So basically, this last 4 years does not compare to the previous 10. So for myself and the rest of advisory, we've really had to get some sort of understanding of that new reality, and what we can basically where the market is and what we can afford to do. But again, if you include the land rent, that averages out for most of my farmers at about 2.8 cent per litre. So that drives the cost of production up to that 41, as I pointed out before. And you can see that has exceeded all of the milk prices since 2021. So we're really in an era that, we haven't hugely got as much understanding of it compared to the previous 10 years. Just to give when
We've lost you there now, Mary.
it's oh gosh, sorry.
Yeah.
I don't know why
So I
it's
think
so
just the
bad.
bottom part of the slide that you're, yeah.
Okay. Can you hear me now?
Yeah, we can hear you. Yeah, you're good again. Yeah, that's fine. So you had said about the adding of lease onto the current cost of production, and I think you'd made another point after that we
So
didn't quite get.
So the cost of production therefore has exceeded price that we've actually achieved prior to 2021. So that's a scary reality. I would just make sure everybody in my house is not using the internet to stop this happening. And then I suppose on the bottom of the slide, we've got the average price there in 2024 for the lads I'm working with. So they get a premium for solids, obviously. So it's not the base price, but the average price paid was 55. In comparison, in 2023, we were working with 45. So we lost 10 cents a litre, and we look very much like we're heading to that, if not less, which is the slightly worrying point. But we have actually still had an inflation in costs. So in 2023, our average cost of production, now this is a cash cost again, so people can get a bearing on that, was 39 cents. We're now nearly at 42. So preliminary results to date indicate that the milk price is 56. So a cent more than what we achieved in 24. So again, a nice year, a comfortable year, but it was also coupled with good productivity. We've had good milk output per cow. But the cost of production is inflated again. So you can see the pressure with where milk price is going when the average cost of production is nearly 42 cents a litre. Now, the only bonus that we've had is stock sales, and they have nearly doubled in 2020. When you look at calf sales, cull cow sales, and some have achieved even more where they've got substantial dairy stock sales. So that's the only bonus we've got to potentially consider going into 2026, that we might have very decent stock sales. So look, I suppose the key thing in terms of trends are that to take from what I was trying to get from you, there is a huge opportunity for everybody, apart from the top 10%, to actually improve in profitability if they
Sorry, I think there's something there. Was there somebody asking a question? Sorry, Mary.
I think it might have, yeah.
No, that's fine. Work away. I've just gotten some feedback there that the line is quite bad, Mary. I wonder, would you be okay with switching off your camera and then maybe the volume might be a bit clearer from your side? Would that be okay?
Yeah, no bother at all.
Thank you.
Okay. Right. So yeah, the key thing, the key thing to take from this is that for most, there's an opportunity to significantly improve profitability for most, because the top 10% generally make 3 times more than the bottom 10%. So we can move. We're all not equal though. Realize there's a huge impact of location, soil type and weather. And even from 2025, I know there was a significant impact of drought. I do know financially drought is not as bad as wet, but it still has a huge impact on the cost of production. So we're all hoping for a good year in 2026 as well. The key thing from the graph to take as well is that we are in a period of significant volatility. The highs and the lows have become 10% more extreme. So that's getting very hard to deal with. There is always a certainty in price cycles, but milk price has a significant impact on profitability. And it seems that without those mechanisms of intervention, which impact on supply and demand, that it is having a huge impact on the price that we do receive. So that's going to be a challenge going forwards that we have to manage. So it's often a reality that you will see a period of 18 months good to 18 months bad. So whilst the price is depressed and hopefully not as bad as we once thought, this period of low price could linger on for 18 months. Hopefully we'll get out of it in 12, but it's just to have some, when you're doing your financial planning, to scope out a little bit longer. And you need to realize in a period of low milk price and pressure, you need to protect your working capital. And this will become quite an important element of your resilience to make sure you have enough to actually make the cash flow function, because cash is fundamentally very different to profit. So as I pointed out, the cost of production has increased by 40%, which has been hard to bear. It's hard to believe in 2021 that the farm working expenses, which is a cash cost, was only 28 cents. So it's been huge. Most felt a financial pain in 2023. So that's by demonstrating that once we reduce to profitability of €1,000 per hectare, whilst historically that was very comfortable, it isn't anymore. The other horrible thing is that Mother Nature is still in charge, and that bad weather does have a significant impact on production and profitability, and it does rise costs. And so, yeah, we need to now implement strategies that maximize profit when faced with high and low milk price years to cope with that volatility. So the key thing I need people to understand for 2026 is the difference between a bad year and a good year. So we're going to take here 2023. D wasn't the worst, but it wasn't great. This is a correlation. It's basically a statistical graph between profit on net, which is, and the expenses that people are functioning at on farm. It's comparative expenses, so it doesn't include land rent, but it does include pretty much everything else. Key thing to take from this is a very strong correlation. The R squared is 0.8. So that says that basically profit is determined 80% by your cost of production and the ratio of your cost of production. So we're trying to target less than 65%.
I think we've lost Mary. Mary, can you hear us there?
Generally obvious, but
I'm
it
sorry,
makes
Mary. You
that.
might have to go back on that. It's cut out again.
Okay,
Yeah.
1 second. I'm just wondering if I switch over to my iPhone, would I be better off for you?
Yeah, if you want to keep sharing your screen on your PC there, Mary, and maybe do your audio from your phone, it might work better.
Okay. Sorry, double jabbing is always a bit challenging.
Just if anybody has any questions, feel free to pop them into the chat box and we can get to them then.
Yeah.
Maybe when
Okay.
Mary
So
has finished her presentation.
yeah,
Yeah.
the
Okay, go
key
ahead,
thing
Mary.
is,
Yes.
yeah, the key thing to take from this is that in a bad year, that pretty much nothing else matters most of the time than the cost of production. Okay, so it's hugely correlated to profit. And there's not a lot of other factors influence. Whereas if you look at a good year, so 2024 was a good year, the R squared reduces, it becomes less important. Other things matter. So the key thing as you go into 2026 is that cost control above everything else is an absolute number one focus. There is nothing else. And just I exemplify that these refer to those R squared values of those correlations. So the reliability, so the reality. So in 2024, as a well, we'll put in 2023, as I outlined before, the thing that affected profit the most was expenses. It had an 82% bearing on it. But when we correlated milk income to profit, it had a very small impact. It didn't really matter. It was 24%, really low. Whereas in 2024, the cost of production didn't matter quite as much, but the milk income did. So it's how much milk you produced and the price that you were paid had a huge bearing on the profit that you achieved. And that's the reality with 2025. 2025 sets you up for a fall if you keep the same sort of perspective of how to make money. So in 2025, it became quite obvious to a lot of people, if you fed cows to produce milk, you were gonna make money, and you did make money. It also gave you a sense of comfortableness in what you could do. It allowed people to experiment in terms of systems, adding costs, and they could get away with it. But when you're faced into a bad year, the milk price is poor, the only thing that matters is that cost of production. And if we look down to 2016, which is one of our worst years, where the profit fell to €700 per hectare, you can see that the expenses had a 90% bearing on the profit achieved, and that milk income, so the amount of milk produced, had 12%. Not even worth talking about. So the cost of production in a bad year is absolutely the only thing you have to worry about. You don't have to worry about whether your cows achieve 500 kilos of milk solids or not. It's not important. It very much becomes about doing it as cheap as possible. So again, getting back to basics, grass being the number one principle. Does that make sense?
Yeah, very clear, Mary.
Yeah. So again, as I said, in one of our best years, if you look at 2022, the cost of production didn't have a lot of bearing, but the milk income had a huge bearing on the profitability. So that's the reverse. In a good year, when the price is good, it's all about making milk and as much of it as you can.
So we basically need to change our mind away from the concentrate view that maybe was there in 2025.
Yeah,
it's critical really from now on.
Yeah.
Yeah.
And it's become quite a habit for the last 2 years to put in a lot of concentrate. If we look historically,
Hmm.
we were able to and comfortable feed around 500 or 600 kilos per cow. That has basically come closer to 1,000, over a ton per cow. There's so many farmers now feeding comfortably over a ton per cow, but we've become very production focused. And actually, when we look at other parameters, the amount of it's the law of diminishing returns now, that the amount of cows they're getting offered between the grass grown and the concentrate fed per cow, they're getting offered nearly 6.5 ton during the grazing season, and it's not delivering the same amount of milk solids. So yeah, there's been a change of focus, and we do need to get back to basics for a bad milk price year. So just to exemplify here the positives of having a good handle on your cost of production, this illustrates the top 10% whose cost of production is 35 cent a litre. The average, as I said, was around 40. It was 41, and the bottom at 45. This speculates 8% of other sales, so that's quite substantial. And it shows that the top 10% can tolerate a milk price reduction of more than 15% less, of 15 of they can tolerate a milk price reduction of 15 cent compared to the bottom 10%. It's huge. They've
It's
got so
massive.
much
Yeah.
more up. And we are trying to aim for a system that leaves us 35%. That is the ideal target. It starts to get under pressure when it becomes 75% or less. So that's why I've coloured those areas in red. But again, you can see the pressure comes on very quick. At 55 cents, there's some pressure for some farmers now at 55 cents. So you take 10 cents off them, which was the case in 2023, you can see there's not a huge amount of profit to play with.
Oh no, I think we have just lost Mary. Um, we'll give her a minute to see if she can log back in, and if not, we'll, I suppose, look at we're gone after 8 o'clock. So, okay, Mary's back in again, maybe. Are you there, Mary?
I am, yeah.
Oh, we lost your screen there. Yeah. Sorry about that. Look at
Yeah, no, you are sharing. I'll stop the share and I'll replace the share. So sorry about that, and apologies. I don't know. I'm not getting any indications here that the Wi-Fi is as bad as it is. So I'll try and get it fixed. Uh,
no, don't worry.
as
Are you able to share again? Yeah. And
yeah,
maybe I'm not too sure if you
oh,
have many slides left, but maybe
not
we'll
not
focus on the
huge.
main ones. And yeah, sorry
Yeah,
now.
and
I don't issue. It's just
no,
us.
you're fine, and we can. I'm just trying to be clear for people, but we can put these up afterwards as well. But look, for 2026, cost control number one priority. Production is vanity. It is getting back to basics. Grass is your cheapest source of feed. You need to use concentrates only to fill obvious and measured deficits. You need to implement cheap systems. We have been pushed into a situation where we have quite happily accept more expensive systems in terms of breeding and animal health, rearing calves, and they need to be reviewed. Deferred payments are important. So this basically means in a bad year that you would not focus money into R&M and you delay capex, you'd probably use it the other year or you'd finance it. And so Donal can talk about that. Whereas in a good year, hopefully some of you have thought to forward purchase, that you did do R&M, that you did resurface roadways or what have you, and that you had plenty of fertilizer and medicine. You put stocks in place as well. You forward purchased, and it's important to have adequate working capital on the 1st of January when you're facing into a bad milk price. That's the key thing. And the last point, and the one that we're really struggling with, because for the last 3 years we have had a reduction in grass growth, is not to overstock the farm. You have to get the stocking rate right. And you're actually starting to find on some farms there's a huge amount of meal going in just simply to prop up the stocking rate because they are not growing the grass. So again, it's getting back to basics. Make sure you actually walk the farm regularly. And I suppose,
Is
look,
there
I
room
said
for
not all
culling as well then as there, Mary? Do you think when would people want to start
yeah,
considering that? Yeah.
drop the top so to drop the bottom 10% of the herd, yes, there's definitely room for culling. I said not all farms are equal. We'll scrap that and you can refer to that, but it reduces your productivity and increases your requirement for capex on farms. So look, managing cash flow is going to be a key point. Our business is seasonal. In a good year, you get that balance of payments where basically the income coming into the farm will cover the outgoings, usually around May, June. But in a bad year, this pushes out to October, sometimes to November. So it's being prepared for that and to make sure that there's enough in the system.
I have to apologise now, guys, on
Yeah,
this.
I
Oh, you
might
there,
work.
Mary? Yeah, we lost you again. Sorry.
I've buried without the slide there, but basically you need working capital of around 400 to 600 euro per cow. And it's probably to prepare for that for 2027 as well. So,
That's
there's a
coming
few.
into the year that people
Yeah,
need to be looking at. Yeah.
and look, you can use it in different ways. You can, obviously, a lot of people function on overdraft, merchant credit, but if you are short of cash, be sure to talk to the bank and make sure you're in the right position. And then if you wanted serious long-term security, you'd put a slush fund war chest in place, and that works out at about 800 euro per hectare. So look, your conclusions are simple. Period of extreme volatility. The cycles are certain, but the degree of volatility we've experienced is substantial. But the challenge is it's allowed us to inflate prices, cost of production. So we need to be conscious of that. It's at 40 cent. You've got some serious homework to try and figure out where you can reduce that. We have come production focused. The average meal fed in 2024 was 1,200 kilos per cow. It's substantial. We need to get back in 2026 to systems that promote low cost of production to be resilient. So yeah, grass to milk is your primary focus, and protect your cash reserves, your working capital, very important. Donal, it's over to you, and I apologize, I've had such Wi-Fi trouble.
Mary, thank you for that. I think a few questions have come in there, so it'd be a shame not to address them.
Yeah,
Like,
fire away.
and it's
Yeah.
great for, I'm delighted to see people asking questions. Is there a minimum amount of concentrate that needs to be fed to ensure the health of the cow? I don't know, what's your viewpoint on that, Mary, or where would you
Not
sit
for the
comfortably with that? Yeah.
not not for the health of the cow, in some ways, but things have shifted. So in 2009, I did have farmers. I had one farm in particular that only fed, I think, 95 kilos of concentrate per cow. His herd were perfectly healthy, but we were in a reality that we got less milk solids per cow. So we have managed in this last 15 years to add on over 100 kilos of milk solids per cow because we weren't quota restricted. So it does change the focus. So no, it doesn't make them particularly unhealthy, but if you do need to manage condition score, and after calving, it's imperative that we manage that. So in terms of the priority of putting concentrate into our system, this is an order. The order is quite simple. The best bang for your buck is autumn because it pushes grass forward and it protects the condition on the cow. The next bang for your buck is spring, again, because you're protecting the condition on the cow. The least bang for your buck is summer, and that's the hardest time to put it in. Now, in terms of breeding, it's always thrown at me that I need to put the meal in to get cows in calf. The actual reality is meal drives milk, and milk is inversely related to fertility. The more milk you drive out of the cow, the less likely she'll get in calf as well. So you need to keep that in balance. We don't need the level that's gone in. Now, the only thing is we are getting cows peaking at over 2 kilos of milk solids per cow. There is a degree of pressure on them, especially when they're doing 2.2, 2.3, that there could be that negative energy balance. So again, it needs a good grass manager. So yeah, they probably do need 2 to 3 kilos. The challenge is, do they need the 6 or the 7 or the 8? That's where you come into debate, and it's about that grass supply and stocking rate challenge, probably carving spread as well. Yeah, so there's a few things to play with there. So you could say, yeah, there is a justification for some meal in spring. Is there a justification for 2 kilos the whole year round? No. And that's going to be the biggest challenge for fellas.
Okay, thank you, Mary. And then we have, where is your line in the sand for land lease prices? So what do you think on that?
It is actually subjective to what your profitability is. It's also impacted by whether it's milking platform or not. I find, especially in the territory, I get antsy if it goes above 300, which is low water. But like, again, wet area, can't guarantee the productivity as much. And again, it's subject to whether it's milking platform or not milking platform. The top 10% can easily pay the 500, but I don't think the average can. No, it's got out of hand. So that's where I sit with that. I do have a table for my groups to work with, so they can figure that out.
That's great, Mary. Thank you for that. Look, we might move on, if that's okay, to yourself, Donal. Thank you for joining us this evening. We're delighted to have you here with us. And maybe if you just give a very brief introduction, I suppose, and if you,
Yeah.
you can start with your presentation. We can all see that there. And I think everybody can hear at the moment. So yeah, and thank you very much, Mary, for that. If there's any more questions, we can deal with them at the end again. Yeah.
Thanks, Deirdre. Can you hear me okay?
Yeah, perfect. Thank you.
Yes.
Perfect. Good evening, everybody. And firstly, thanks very much to Deirdre and Albie and Mary, and also to the Dairy Women of Ireland organisation for the invitation to join your webinar this evening. Donal Whelton is my name. I work on the agri team in AIB. I am from a dairy farm in West Cork. As I always say, my brother's got the cows and I got the road, so I don't know who's better off, but obviously delighted to be here this evening. So what I want to do maybe for the next 20 minutes or so is to maybe just set the scene in terms of where the dairy sector is from a banking point of view, and where AIB faces, or where AIB views the dairy sector. Obviously, we're facing into a more difficult 2026, and also then I want to talk a little bit about the supports available from AIB, and also how you can build a more resilient business in your own dairy sector for your own dairy, your own dairy farm. So setting the scene, I suppose, first and foremost, and Mary would have touched on this, is the level of volatility that has become more pronounced and much more evident since 2021, where we can see, when we're looking at the National Farm Survey, the average dairy family farm income over the last number of years has become a lot more volatile. We can see that it obviously peaked in 2022 at nearly 160,000, but dropped very significantly and very, very sharply in 2023, down over 100,000 euros, before recovering somewhat in 24, recovery again in 25, and obviously with the outlook there then 2026, and more pessimistic outlook again now for 2026, maybe hopefully not as severe as it was in 2023. I suppose from our point of view, it just emphasizes the importance that no farmer and no dairy farmer should make any long-term investment decision based on the financial performance of their farm in any one particular year. We certainly in AIB don't look at the performance in any one year of a particular customer's farm. And what we like to see, and what we advise everybody, is to look at your average profitability over the previous 3 to 5 years and use that as a barometer of the profitability of your farm going forward. When we do that, looking at National Farm Survey figures over the last 7 years, you can see that the average family farm income in a dairy farm over the last 7 years, represented here by the red line, is just approximately 100,000 euros. But we have that significant volatility ranging from, as we see, 160 down to nearly 50,000 euros in a 12-month period. In terms of the financial strength of an individual sector, and I suppose the financial strength of any individual sector can usually be demonstrated by the level of working capital that sector uses in a particular year. And what we're looking at here is the level of overdraft utilization among our portfolio of dairy farming customers in AIB. And we're looking at the data here for the last 5 or 6 years. And if we look at 2025, it's represented here by the light green or the light green line. And we can see it has been tracking down very low utilization, similar to the blue line, which represents 2022 overdraft utilization. So relatively low levels of utilization, both in 2022 and again into 2025 and throughout the year 2025. That being said, as we saw previously, we had a difficult year in 2023, and what that materialized in terms of overdraft utilization that we saw again represented here in our grey line 2023, we can see the increase in dairy farmers using the amount of working capital that was available right throughout the year in 2023, and actually peaking the utilization, peaking at relatively, I suppose, maybe twice the level as it was in the start of 2023. In Q1 2024, we had relatively high levels of overdraft utilization among our dairy farming customers. And again, looking at the outlook maybe for the next 12 months, we're expecting a similar increase in the overdraft utilization among our dairy farmers for the coming 12 months. But having said that, it is at relatively low levels currently. In terms of the level of debt in on farm and what's been happening with the level of debt that farmers have, and again, what we're looking at here is central bank data of the total level of debt that all farmers in the Republic of Ireland have across all financial institutions, and it's represented here by the red line. And I went back as far as 2008 because the highest level of debt that farmers had in Ireland, it actually peaked in Q1 2008 at 5.2 billion euros was the level of debt on Irish farms in Q1 2008. And this is for on-farm investment. So we're talking either for borrowings for land, buildings, machinery or livestock. So 5.2 billion in Q1 2008. And every year since that, we've seen a reduction in the level of debt on Irish farms as farmers are starting to pay down debt at a much quicker rate than they are taking it on. And the next slide, I'll talk a little bit about the levels of debt that farmers are borrowing each year on their farms. But when we look at the total level of debt represented by this red line, we can see, as I mentioned, Q1 2008, 5.2 billion. And when we move forward to H1 2025, we have now nearly the lowest level of debt in the past 20 years. And the debt has nearly halved over the last 20 years, and it's now currently at 2.8 billion. I suppose what's also interesting when we look at, again, central bank data in relation to cash balances or deposits that are available in primary industry deposits, which primarily are the agricultural sector. Again, central bank data, you go back to 2008, we had approximately 3 billion of cash balances available across all farmers, across all financial institutions. And this green line represents the increase in cash balances that farmers have been accumulating over the last 20 years. And currently, we've nearly over 6.5 billion of cash balances available. So I suppose the point being is that that loan to deposit ratio in relation to Irish agriculture has completely turned and flipped in the last 20 years. So again, a very positive news story in relation to the financial strength of the Irish agricultural sector.
We have a question there, Donal. So in 2008, was there any off-farm investment debt included in that?
That's stripped out of this data, Deirdre.
Okay,
so yeah, that's separate to that. Yeah.
And then do we think that like maybe, the reduction in debt is due to a reduction in people actually investing or, reduction in farmer numbers, or is there any link there? Yeah.
So the next slide is looking at what's the amount of debt that farmers are actually borrowing each year. And again, this is all farmers in the Republic of Ireland borrowing for on-farm investment from all the financial institutions in the country, Central Bank of Ireland data. And you can see the average amount there. It's averaging approximately 689 million per year every year. We can see in H1 2025, the most up-to-date data we had, it was 310 million Irish farmers had borrowed in the first 6 months of had drawn down in the first 6 months of 2025. When we get the year-end data for 2025, we expect it to be on par with 2024. But you can see on average that farmers are borrowing. It peaked into 2017 at 790 million. The lowest year was 2022. I suppose farmers had good dairy farmers who make up a lot of the borrowings that are drawn down. They had a relatively good year. It was still 620 million were drawn down by farmers in that year. So on average, over the last 10 years, it's averaging about 670 million each year, every year. So approximately 7 billion euros over the last 10 years of drawdowns in loan facilities among all Irish farmers in the Republic of Ireland. And of course, this doesn't include investment that farmers have done from cash flow. So again, a very good news story in the sense of this is the level of new debt that's been taken on by Irish farmers every year, but the reduction in overall balances and the overall level of debt continues to reduce, so that the flow back of money and the repayments is much faster than the level of debt that's been taken on each year. So again, a very good news story for the Irish agricultural sector. Again, just looking at some National Farm Survey data and looking at what sectors have debt and the level of debt on those sectors. And I appreciate averages can be misleading, but again, it does show it does tell us a trend in relation to levels of debt on farm. So I suppose, again, when we look at the most up-to-date data, which is 2024 data from the National Farm Survey, I think it's interesting to note that dairy farmers were the only sector where the percentage of farmers with debt increased in the most recent data. So it went from 67% of farmers, dairy farmers with debt in 2023 up to 70% in 2024. Every other subsector in Irish agriculture, the number of farmers or the percentage of farmers with debt actually reduced. And also for dairy farmers, the level of debt on farms increased from 130,000 euros up to 147,000 euros, which, I'm not trying to belittle the level of debt, but when you compare it to the average herd size, it's approximate debt of probably 1,500 euros per cow. And also the other point to take is that nearly a third or 30% of dairy farmers in the country have no debt. When we want to maybe just look at how does this compare with some of our European counterparts. So again, when we look at the average debt on Europe, it's nearly double what it is in Ireland. The EU average, the level of debt on dairy farms in the EU average is double what it is in Ireland. In relation to Germany, it's 3 times the Irish level of debt. In the Netherlands, it's 10 times, and in the Danes, it's nearly 30 times the level of debt on dairy farmers. So again, and I suppose the point that I'm trying to make is that we're facing into a downturn in 2026 in terms of milk price, but Ireland has another competitive advantage compared to our European counterparts, given the relatively low level of debt that Irish dairy farmers have, and obviously did reduce cost and cents per litre financial costs because of the lower level of debt that Irish dairy farmers are servicing compared to our European counterparts. One point to note, of course, though, and Mary touched on it in her presentation, and again, looking at National Farm Survey data, is what's been happening with costs on farm over the last 5 years. And when we look at 2020 versus 2024, total costs on Irish farms has increased by over 46% in that 5-year period. Obviously, we have seen the Ukraine-Russian conflict drove the increase in fertilizer and energy costs in 2022. We also seen an increase in machinery depreciation and building depreciation again in 2022 because a relatively good year in 2022. Many farmers would have spent money on capital expenditure and on machinery, and that's being depreciated over the coming years. So an increase in depreciation and building depreciation notable over the last number of years. But I suppose what is very noticeable also is the increase in concentrate cost on dairy farmers, and driven by obviously an increase in the cost of it, but also, as Mary pointed out, an increase in the usage of concentrates also on Irish dairy farmers, where in 2024, the average dairy farmer, it was equating to nearly 9 cents a litre of their total costs. Concentrates was nearly 9 cents a litre, with concentrates costs increasing by 56% over that 5-year period on the average dairy farm in the National Farm Survey. So that leads me into maybe looking at building in resilience and making your farm financially resilient. And what are the things that, from a banking point of view, that we look at, particularly in a period, obviously, of poor milk price? I suppose the first thing that we would look at with customers is asking them, what is their break-even milk price, and do you know what your break-even milk price is? And when we talk about the break-even milk price, it's the price of milk that you need to cover both your fixed and your variable costs on your farm, but also to cover your financial costs on your farm, which is your living expenses. And we know the increase in inflation with regard to living expenses on farm. Also, the expense in relation to paying the taxman, and also then the expense in relation to paying existing financial commitments. So this is a very quick example of how we would calculate, or what we would maybe look at when we get a set of audited accounts, what a farmer's individual break-even milk price would be, providing everything else stays the same in the set of audited accounts that we're looking at. And in this example here, we're looking at a 100-cow dairy spring calving dairy herd producing 510,000 litres of milk. In this scenario, we had nearly 36,000 euros of non-milk sales. Farm expenditure was 173,000 euros. So the surplus before drawings, tax and financials was 143,000 euros. Of that, though, 52,000 euros was needed to run the household. The taxman had to get 14,500 euros, and the financial repayments, the existing financial repayments, were 18,500 euros, to give a net surplus of 58,000 euros in this particular year. The next thing we do is that we determine what the actual milk price received, and in this scenario it was 55 cents a litre. We then divide that surplus that the farmer had in the particular year of 58,000 euros into the total number of litres of milk that was produced, of 510,000 litres, to give us the surplus on a cents per litre basis of 11.3 cents a litre, which, when we deduct then from the actual milk price the farmer received, that's their break-even milk price is 43.7 cents a litre. So if everything else stayed the same, the farm expenditure, the household expenses, the tax liabilities, and the financial repayments, this farmer needs 43, nearly 44 cents a litre to cover all their financial outgoings from their farm. And then the question is to be asked, what is the projected milk price that you foresee for your farm for the coming 12 months? And for example, if the answer to that is, say, for argument's sake, 40 cents a litre, that farmer has a deficit of nearly 19,000 euros that needs to be filled in some shape or form. So then the answer, or the question is, so what to do once we've determined what the deficit is, all things remaining equal with regard to our expenditure on the farm? What can we do with a deficit? And again, there's some crossover here with what Mary was alluding to in her presentation also. But the first thing we have to look at is there non-essential spending in the farm expenditure. So, for example, in the 173,000 euros here that was incurred in running the farm in this particular year, was there non-essential or once-off items that wouldn't be there or doesn't need to be spent in a poor milk price year? For example, repairs and maintenance or capital expenditure that was funded from cash flow. With that deficit, is there cash reserves available to cover shortfall? And in my next slide, I'll talk about some guidelines that we would like to see with regard to available cash reserves. And then also, is there an option to build creditor debt? In terms of bank support from AIB, if that is what is required, we're very much of the view that there is no one solution will suit every farmer. Every farmer's individual circumstances are different. So we very much of the view that no one solution will suit everybody, and we have a range of options that we can tailor, or a combination of these options that we can tailor to suit your particular farm. And these can include, for example, and I suppose the first one that a lot of farmers think of is in terms of working capital, an increase in your overdraft or an increase in your farmer credit line, which is fine and maybe the right thing to do, but it can be the most expensive way of dealing with a particular cash flow deficit. It can be more cost effective maybe to look at taking out a term loan to cover any deficit, or in many cases what we find, and we found this particularly in 2023, that many farmers had funded capital expenditure or had bought machinery out of cash flow when milk price was, or when cash flow allowed and milk price was good. And we can look at retrospectively funding that capital expenditure and putting that funds back into the farmer's current account. So for example, in 2025, if a farmer had spent 30 or 40 or 50,000 out of their own cash flow on a capital expenditure, such as maybe calf house or a silage slab or buying a new machine, and once they have an invoice to prove that they have done it, we can retrospectively look at financing that and putting the cost that they incurred and the costs from their own cash flow back in their current account, and term out that expenditure out over a more appropriate time. Another option that some farmers nearly always refer to is looking at going on interest only on existing facilities, which is an option. But for us in AIB, it's probably the option of last resort that we will look at. We will look at all other options first, because going on interest only does have maybe implications with regard to your credit rating. And these are guidelines, or maybe they're rules that the central bank have given to financial institutions in relation to forbearance requests, where a customer maybe have taken out a contract to pay back a loan and now find themselves in a position where they can't make those committed repayments and are looking for a period of forbearance. So it is available, but it does have implications, and for us, it's the option of last resort that we look at. Obviously, in a poor milk price year, and Mary touched on it quite significantly in her presentation, that focused on costs. Where is my break-even milk price? What is driving the increase in costs? Where am I offside? How can I fix it? And why am I offside? In addition, I suppose for 2026, we also would recommend, obviously we know, and we've been talking about 2025 was a relatively good cash flow year for dairy farmers. So again, there is going to be tax liabilities that will become payable in Q3 or Q4 of this year. So again, to ensure that there is no nasty surprises, go away and prepare your 2025 accounts as early as possible and identify that tax liability and know what you are facing in with regard to the tax liability that you will be having to pay throughout or in Q3, Q4 of 2026. In terms of practical examples then of resilience from a banking point of view, and it's been touched on as well in Mary's presentation, a buffer fund, cash reserves, how much or what would a bank like to see? And I suppose there's two elements here, and Mary touched on in terms of what buffer fund or cash reserves we'd like to see in terms of working capital, and it's been referred to that obviously we'd like to see about maybe 400 to 600 euros per cow available in terms of working capital support at the start of the year to carry you through, particularly during a poor milk price year. And also then in terms of a buffer fund that's available to meet bank repayments. And I suppose, again, ideally from a banking point of view, and especially where borrowings are in excess of 3,000 euros per cow, we would always like to see maybe at least 12 months repayments being available in a deposit account or as a cash reserve to meet those bank repayments, so that in a particularly poor year that there's no financial draw from the farm to meeting bank repayments, that you have put aside, like in maybe potentially in 2025, you put aside at least 12 months repayments to cover you in 2026, which we know that the same cash flow will not be available. In terms of the working capital, of course, that could be in beef stock, and again, non-milk sales, and again, we've seen that increase, and again, Mary referred to it, we've seen the increase in the value of non-milk sales increasing to be maybe 5 to 10 cents a litre. So again, your resilience, it could be walking around on 4 legs currently, and there could be cattle sales that will provide that working capital support that you need for your farm. Just a comment in relation to debt levels and to structure appropriately, because it is something that we are finding more and more common. And it's obviously a trait that farmers like to pay down debt at a relatively fast pace and like to borrow short term. And in many cases, we can have farmers that have a relatively low level of debt, but that debt can all be short term. And the impact of that is that when you have a particularly poor year, that you can have very heavy financial cost on a cents per litre basis. So you could have a relatively low level of debt in sense of debt per cow, but because it's all short term, you could have a relatively high cents per litre repayment. And just to give the example here of looking at, for example, 200,000 euros, if that was borrowed over 5 years, your repayments are nearly 4,000 euros a month. Whereas if that was borrowed over 15 years, your repayments are 17,000 euros or 1,700 euros a month. And the difference there in a 12-month period is nearly 28,000 euros in cash flow by having debt structured appropriately and structured in line with the term of the asset that you have financed. So to conclude, first and foremost, look, the sector is in a very strong financial position. We have low levels of working capital utilization coming into 2026. We have low levels of debt sector-wide, industry-wide, and the lowest level of debt in the last 20 years. We have seen a significant increase in cash balances and deposits available industry-wide. So the sector is in a strong financial position. That being said, every farmer's individual circumstances are different. And as Mary said, the importance of focusing on costs, particularly in a poor milk price year, is very, very important. What we would say to farmers is that what is your break-even milk price, and if bank support is required. Firstly, what we like to see is identify the cash flow deficit, what level of support is required from the bank, and also then come and talk to us as early as possible. And the reason we say that is that we like to maybe make sure that when a farmer comes to us requiring support, that we put the right amount of support in place for their business for the amount of time that it will take for that farm to be back in positive cash flow again. We don't want to do it in a piecemeal basis. So, for example, coming in looking for 20,000 euros when it's actually 40,000 euros that's required. So allow us to get it right first time and put the right amount of support in place for your business in 2026. My last point that I want to say is just, look, 2026 is going to be a very different year to 2025. It's very important for you to mind yourself and mind your family. You are not alone. It is going to be a much difficult year. But having said that, it's important to look at what's within your control, and cost control is certainly more important in a low milk price a year. But just remember, you're not alone, and make sure to look after yourself and your family. So I will leave it there, and I will open it up for any questions if there is any questions.
Thank you. Thanks very much, Donal, for that. And obviously very much for your message at the end about not being alone. And look, I think we all need to have somebody to reach out to, and that's very important, I suppose, coming into the spring and the year ahead. I'm just having a look here to see if there's any further questions. Oh yeah, have you seen any scenarios where a family farm is worse off in a limited company structure? I'm not sure. What do you think, Donal, there?
Yeah, I do think back maybe 10 years ago after milk quota abolition, there was a flurry of farmers that did convert into limited company and probably didn't do the required due diligence before going into it, and have created some little bit of maybe difficulty in trying to get access to the cash that's in limited companies now, because the director's loan that was created wasn't high enough, and obviously the cash is being generated in the company. It's the company's cash, it's not your cash as a director, and difficulties now trying to access that cash. I do think anybody looking at entry into the director, looking into converting into a limited company, it's a job of work that needs to be done over maybe 2 to 3 years, not rushed in. And the most important thing for us is try to increase that the director's loan as high as possible, so that you can get access to that cash that the company is generating. What we're now finding in some of those scenarios is that farmers are looking maybe at selling some of their land into the company buying that land. So now that the company owes them the money for that land as a way of getting access to that cash, and that has obviously stamp duty implications to be paid, and obviously transferring land into the company. For argument's sake, other farmers may be looking at cordoning off their farm buildings and putting a value on their farm buildings and selling that into the company and paying the stamp duty, etc. Whereas maybe if there was more due diligence done first day in increasing the value of livestock, increasing the value of machinery, etc., that mightn't have had to be done so quickly. But that's the only negative I can come to pass.
So it's about preparedness, really, and making sure it's a work in progress. It's not,
it's not rushed into.
I would say that they'll do as well, like planning to go into that company at the right stage. Again, maximizing the director's loan. Director's loan tend to last for most farmers around 10 years. Would that be fair to say, Donal? And a lot of companies are getting to the point where they're starting to hit that edge of not a lot of director's loan left to work with. So a little bit more creativity coming on board. But it does leave the personal bank account a little bit, especially if there's a lot of borrowings, personal borrowings associated with the farm, buying land and what have you. That is having implications. So a few debates on whether to buy land in a company or to buy it personally in there as well.
We had some scenarios where we had large personal debts for land purchase in personal names, and the director's loan was exhausted very quickly because of the need to draw down director's loan to meet personal bank repayments. So again, it probably wasn't planned correctly.
So it takes time. Is there any more questions that people would like to jump in with? I mean, there was your presentations were very comprehensive, and I suppose they complemented each other very well as well. So thanks, Mary and Donal. And there's like a wealth of information there that's going to be available to, I suppose, everybody who's come on tonight and all of our members. And I'm delighted there's been a huge attendance tonight. And hopefully, I suppose, some of you gave your feedback there around the time of the conference as to what you'd like us to provide you in terms of Zooms and financials. Came up heavy on that. So we're delighted to have Mary and Donal to share their expertise. Just a comment on interest rates. I don't know, Donal, if you've got any insights into that at the moment, or how things are.
So I think interest rates fortunately have stabilized in the last maybe 6-9 months. Obviously, we had a period of high inflation, which led to an increase in interest rates to reduce that inflation over maybe a 2-year period. So I think the cost of funds, the 3-month Euribor, it peaked at about 4%, and we've had consecutive reductions over the last 18 months, where it currently sits at maybe approximately 2% is the current 3-month Euribor rate. And I suppose that is kind of a normalized cost of funds. You'd always like to see maybe a rule of thumb that your cost of funds would marry inflation rate. And so we currently have inflation rates of approximately 2% and cost of funds of 2%. So over the coming 12 months, hopefully, you can never be sure with geopolitical tensions and what can happen, and it's so unstable at the moment. But hopefully that we will see a period. I don't envisage any further interest rate cuts, but hopefully we'll see a period of stabilized interest rates around the 2% mark. Cost of funds, I should say, around the 2% in interest, or cost of funds at around the 2% mark.
Okay, thanks, Donal. If there's no other questions, I suppose we can finish off. We went a little bit over, so I apologise for that. But thanks for your patience, and we managed to hold on to most of you. That's great. And as I said, we'll keep the Zooms is recorded for yourselves. Just, I suppose, to summarise from yourself, Donal, your point of view is the sector is very strong. But I suppose the thing to look out for really is to make sure you know your break-even price coming into the year. And one of the biggest things, and for Mary, obviously, was I suppose keeping the cost of production down as much as possible, and the variance there between the top 10% and the bottom 10% of farms with a profit gap of 2,400 per hectare, and that's massive. So I suppose there's big scope there for people to make savings on their farm and to utilise grass and not meal. And I suppose in terms of building financial resilience, then to build a cash buffer for the business, maintain non-milk income worth about 5 to 10 cents per litre. And then I suppose, sorry, now my notes are leaving. Oh yeah, and I suppose a note then from Donal to act in time and ask for the right amount, I suppose. So I suppose if people get their accounts in pretty quick and get their break-even price going into the year, and please God, we'll have a good weather year. That's the one thing I suppose that's really out of our control, Mary. But if that goes relatively okay for us, then hopefully we can just use the grass and keep the meal aside and focus
a
on
good spring. It'd be very good. But like it is a slightly change of focus for this year, and I think one of the key differences in a good milk price, you can tolerate any stocking rate. That one really does need review for a lot of people. Like, is the grass grown relative to the number of cows you got on farm? Does it fit? Does it suit? And then does it allow you not to go excessive on concentrate? So yeah, all those
fantastic. Thanks a million, guys. Look, sure, we'll leave it at that, and happy 2026 and best of luck in the spring, and we'll be in touch, I suppose, in the near future with our next Zooms. And if you have any feedback, please send it in, or if you want to see anything else in the future. And thank you very much.
Thanks, folks.
Thanks, everybody.